The parallel strain, Jim, that's really worrying the markets is the situation in China as well. There have been aggressive tightening measures that have been taken. The market is pretty much crumbling there, and then there is that immense damage to commodities as a result of all of this. How would you, per se, rate the development so far in that part of the world?
We're just at the beginning stages. This is something that I've been warning about for, for more than 12 months, that when you have irresponsible monetary policy and a massive stimulus program in the back of lending and bank credit, then inevitably you have to pay the piper, usually quite early rather than quite late. So 12 months into this huge stimulus program, China, remember, last year had a bigger stimulus program, mostly through its banking system, than any other country in the world. It added 40% of the previous year's GDP to GDP in 2009 as a direct result of bank credit growth. When you do that kind of thing, inevitably you're going to start asset price inflation, you're going to start misallocation of capital, and that's exactly what's happened in China. They've raised reserve requirements ratio 3 times. It really is a very small step along the road of tightening that China is going to have to embark on. There's been a lot of things done in the property sector, but quite clearly what it has to do is raise interest rates. The one thing that Beijing just doesn't seem to quite understand yet is that interest rates are a price signal, and they're a very important price signal. When you send the signal that deposit rates are below the rate of inflation, then you're encouraging people to speculate in property, speculate in other assets. And that's exactly what's going on in the last 6 months or so. China needs to raise interest rates, and I'm not talking about 25 basis points at a time, really 50 at a time, and it needs to raise them by 200 basis points as a minimum, probably within the next 6 months, in order to even stop the speculative activity in the housing market and in other assets in China as a direct result of negative real interest rates in the banking system. So it's got a long, long way to go. There's going to be a lot of negative news out of China over the next 6 to 9 months. And that will have an even bigger impact on commodities.
Yeah, that's extremely accelerated rate increases, Jim. So that's the question. How much more damage in the commodity universe, or much more damage in the commodity universe, you reckon?
Yeah, because China is going to slow down in the back of these measures. I don't know exactly what kind of growth rate will be reported, but the property sector is the only game in town in a large sense at the moment in China. That's where so much of the money was concentrated last year. As they begin to hit the property sector and effectively stop eventually the speculation there, then you should expect economic growth to come off by 4 or 5 percentage points, I would expect. And that will have a very severe downward demand move in raw materials from Australia, from Canada, from around the world, which actually in an ironic sense is quite positive for India as regards the balance of payments position and inflation.
Shifting focus from the globe to our very own internal pressures in India, Jim, there has been some debate in India whether the RBI is moving fast enough or walking the line well enough in terms of our very own rate tightening measures. What have you made of that?
Yeah, this is I suppose a real kind of bipolar camp or camps in India at the moment. There's those that think that the RBI is fighting inflation and it's way behind the curve, and then there are others, and I'm in this camp where the monetary conditions in India, to me, do not look that strong. There's been a very slight uptick in the demand for credit in the last couple of months, and maybe the RBI knows more of that's coming, and therefore it's moving already to try and offset some of the demand for credit. But as conditions stand just now, both money supply and credit conditions in India, I would be much more worried about economic growth over the course of the next 12 months than I am about inflation. I think a lot of the inflation, especially in the CPI, was supply side generated, not just food, but also changes to the way that the housing component of the CPI was measured. These are going to start dropping out by July. There's going to be, I think, a fairly strong downward shift in inflation after July in India. So that, to a certain extent, that battle will already be won. But I'm just a bit more worried about economic growth. There hasn't been that strong an uptick in capital investment since the crisis onset, and exports, which have recovered, I think will be struggling again before the end of this year. So I'm more in the camp that the RBI is not at all behind the curve. If anything, it might actually be slightly ahead of it.
There's just one counterforce that's been working against all these global fears, Jim, which is that liquidity has been extremely flush for markets like ours, for commodity markets. Would you say liquidity will remain as benign over the next couple of months, including what happens with risk aversion levels as well?
Yeah, there has still been a flow of funds into emerging markets, and India has been a beneficiary of that as well as other countries around the region. And I think to a certain extent there's still some asset shifts to come in the Western world as they increasingly they look at the awful pension outlook for parts of Europe and Japan and the UK. Less so America because the demographics are better, and they look at where the growth is going to be over the next 5 to 10 years, and it's certainly true that the emerging markets still hold the best promise, so that there's likely to be asset allocation shifts, but at the same time there's going to be I think some volatility in those emerging markets. We're already seeing policy moves across the board from India, China, Australia, not quite an emerging market but a commodity country, and they've raised interest rates again today. From some of the countries in Latin America, even Eastern Europe, where of course conditions are much more muted, but they just won't be able to get off their backs because of what's happening with Western European banks and what's happening in Southern Europe. So there's a lot of reasons to be a bit tentative about the money flows into emerging markets. And again, it really comes down to the quality of the market in question, where the best earnings are, where the best companies are. And in our calculations, it's still the case, and I've said this many times in your programme, the return on equity in India is double that in China. It's better than anywhere else in Asia. There are plenty of frailties in the Indian stock market and with Indian companies, but when it comes to return on equity, it's one of the best places for foreign investors to be, especially on a long-term basis, given the demographics of India and the potential for growth there. So there's a selective process really to be undertaken in determining where assets should be shifted to. But India, to my mind, still looks like a pretty strong contender for a lot of that money flow.
Jim Walker, thanks so much for joining us on the show this morning with your views. That was a very important voice on the kind of movement that the economy will see on account of the global chaos that many markets have been seeing. He's seeing a whole lot of pressure come in from China and the commodity index as well.